Well, I hope you had a wonderful weekend. And as we get ready for a new trading week, there's a lot on the agenda. We'll start with the fact that there's continuing uncertainty surrounding trade. I know we've talked endlessly about that story, but it is once again front and center. And as we were mentioning, it's arguably one of the factors that's leading to a pre-market decline in stocks. You add to that we are about to get a big round of earnings from corporations across North America. We'll see how companies have been faring during all this back and forth with trade. And you do have an up month so far for the U.S. and Canadian stock market, but a little less oomph than what we had seen in the previous couple of months in that big move off the April lows. So for more perspective on the mood of the markets, let's bring in longtime guest Dan Rohinton. He's a portfolio manager at IA Global Asset Management. Dan, it's nice to see you. What's your general take on the mood of the markets here, kind of mid-July-ish?
I think relative to other summers, it seems pretty much in line, right? So there's a lot of news flow, but I think it's important to take it into stride, and that's what the market is doing. So it's clear that this is more negotiating tactics. So we're in the middle of the tango, John, when it comes to the whole what's the actual end state of the tariff rate when it comes to negotiations that are ongoing between different countries. But beyond that, it's pretty quiet and waiting for earnings season to really set the tone for where and how resilient certain companies are and other companies that may not be.
And what's been your general advice to clients? You know, you've had a lot of momentum. Stocks are still pretty close to record highs, but sometimes when you get those all-time highs, that, you know, brings up the question of whether this is a pause point.
Yeah, I would say that the endpoints that we have seen in some of the negotiations that have finalized aren't necessarily all that constructive, but this isn't the doom loop that it was a few months ago. So I would say there's probably a bit more caution that should be expressed in the market than what we're seeing. So I wouldn't say we should be ripping and tearing to all-time highs, pushing up on valuations. But, you know, that's more of just a glass half empty perspective on the whole thing. The main countries that have come through, they're not great endpoints to start with. The other countries, you hope that they are a little bit better. But the key thing here is, when do they start collecting? Is it a slow process? And how much of the pain is offset by the actual producers of the goods as opposed to the end consumers? Because right now it looks like the end consumers are going to be absorbing the vast majority of it. But once again, these are Q3, Q4, Q1 of next year type of headwinds that may be manifesting, and they could all turn on a dime because you could easily walk these threats and end state tariffs back even more so.
And so are you, like, if you're trying to pick companies that might be less caught up in the tariff weeds, is there a way to do that? Like, are there any areas that you feel are perhaps a little bit more insulated from the tariff uncertainty?
Yeah, and I think I'll tell you, the one area where this conversation is very difficult to really step away from is the consumer discretionary sector. But completely shift to the other side of the coin, look at parts of the material sector, and we tend to be very focused on the quality of the companies and the business models and value chains that are robust. So there's actually a few stocks inside materials itself that do things like industrial gases, aggregates and concrete, very local for local businesses, where it's really dependent on the age of the road or the project that's at hand in that domestic metropolitan area versus all the big things going on between interwoven global supply chains.
Okay, as an example, you talked to our team about a couple of individual stocks. One is CRH. This is a building materials company. You were just talking about, you know, the need for infrastructure. So I guess that would feed into that story.
Exactly. And so there is actually, believe it or not, a lot of cement and aggregates that do move around the world. But more than that, it is local for local. So you have your local quarry. You basically truck those aggregates and then that ready mix cement over to that local manufacturing facility that is being built up, like, or a data center as an example, and residential construction. So when you think about the United States and its reindustrialization, CRH, along with some of its peers like Vulcan Materials and Martin Marietta, are truly one of those direct beneficiaries of that. And let's not forget how old infrastructure really is, especially in the United States. I think the average age of the roads and bridges is somewhere between 48 and 50 years old. So this public services work needs to be done irrespective of the fiscal position of the United States, irrespective of the tariff dynamics that are happening on the geopolitical stage. This is roads that need to be paved, and CRH is a company that helps do it.
And another company that you've flagged is Linde. I guess they are industrial gas and engineering is kind of their sweet spot.
Yeah, and Linde, Linde Corp, not to be confused with the chocolate maker. But when you think of Linde, think of that truck that you drive by on the highway that has that gas that's known as merchant gas. But what they're really doing is when you see a big manufacturing facility in a complex, you'll see a Linde air separation unit in there more likely than not. And what it is it's a local monopoly around that, which is where those trucks go. And specifically to that facility, it's a take or pay agreement. So as long as the project is built, the need for specialized gases is there, especially in advanced and modern manufacturing, which is the vast majority of what we do in North America and Western Europe. That is where that need is. And then you also have a monopoly in and around the direct vicinity. So you have rational capital allocation, you have a reasonable leverage profile, and you have local for local, which is in an environment like we are today, something that is a bit of a standout trait right now.